We've got Gopal Balachandran, who is the CFO as well as Chief Risk Officer at ICICI Lombard, here to talk numbers. Thanks so much for joining in. Now, off late, you've been focusing on retail health. Is the growth achieved in the retail health space sustainable according to you? What kind of guidance do you have for FY24?
Yeah, I think that's a good start. So if you look at, for us, retail health has always been an area of opportunity, as what we have been talking right through the last several quarters. And we continue to kind of make investments in adding headcount, who would be essentially health agency managers for ICICI Lombard. And they would obviously go out to the streets and possibly get incremental agency distribution. And what we had kind of talked to the market was, obviously, we want to see these investments play out in terms of incremental growth. And we are happy to note that when you look at, let's say, for the last couple of quarters, the growth for ICICI Lombard on the retail health segment, in fact, has been better than the overall industry numbers. And we are also kind of, in the last 4 out of 6 months, in fact, growing faster than even the standalone health companies. So from an ICICI Lombard standpoint, we are quite excited. And health clearly is an area of opportunity. As you would see, for example, health is by far the largest contributor to the overall revenue for the industry, even as we speak. So hence, we are staying invested in that particular segment of business. And obviously, we would want to look at increasing our market share as we look forward.
Right, and as you switch focus to health, you currently have a small piece of the market. The largest player holds a dominant share. Can this significantly then contribute to your business going forward?
So absolutely, I think if you look at as a company, ICICI Lombard has got a market share of 8.2%. But if you look at maybe the retail health space, particularly in the indemnity side, we would possibly have a market share of maybe 3%. And that's clearly the opportunity that one sees. And what I just mentioned, clearly the investments, what we made, for example, last year we talked about adding about 1,000 people on the rolls of ICICI Lombard, who in turn will, as I said, go out to the streets and possibly get about 15 to 20,000 agents. We are on course for that particular incremental agency distribution in terms of acquisition of distribution. And they in turn, as I said, early signs are extremely kind of successful in terms of us growing faster than even the standalone health companies. And in terms of the relative comparison with maybe the largest player, obviously there is a catch-up that we have to make. That's predominantly because we started focusing on this segment only since the last, I would say, seriously in the last 3-4 years. And clearly the roadmap for us is to look at increasing the market share in this particular segment by both coming out with new products, and at the same time staying invested in expanding distribution.
On the motor OD side, when do you expect to see growth starting to recover, and what will be the factors that you would look at which will help you drive the growth?
No, so motor is the preferred segment for ICICI Lombard in terms of the opportunity that one sees. If you look at the thought process, what we have been kind of driving is, it is not that we don't want to kind of grow, but the market is at this point of time staying at an elevated levels of competition. And in the backdrop of competitive intensity is where we have been a bit guarded, particularly in the private car segment. However, when you look at us in terms of growth in two-wheeler and commercial vehicles, both of them have kind of done reasonably well. So that's how we clearly look at positioning in terms of growing this particular portfolio. On the demand side, in terms of the market, I think private car demand is quite solid. Even the commercial vehicle segment has been doing quite well. It's a two-wheeler segment which is still not completely out of the woods, which hopefully we expect maybe in the second half of this year, things coming back in terms of growth. From our standpoint, I think we are kind of staying invested in, as I said, building distribution even on the motor agency front or other channels of distribution in terms of, let's say, dealership access or the capability that we have created on the digital side as well. And already we are seeing some early signs of a bit of competitive intensity getting easing. And hence, to that extent, we believe we are in the right spot to possibly capture this opportunity for growth.
So is the combined ratio target of 102% by FY25 comfortably achievable? What factors were you to look at if you were to overachieve? And would you be able to consistently clock in the 17% ROE?
Yeah, I think so your question has two parts. If let me address the first one in terms of the combined ratio trajectory. From an ICICI Lombard standpoint, as we have been talking through, not just now, even at the beginning of the year, as I mentioned, and maybe even 1 year back, when we did the transaction with Bharti AXA, even at that point of time, we had indicated that the combined ratio trajectory for us will see a gliding path from the current levels at which they were operating at to maybe, let's say, 102% over the next 2 years. So at this point of time, we are not changing any of that thought process of bringing down the combined ratio to 102 over the next 2 years. Some of the levers obviously will be the kind of business mix that one wants to write, the price increases that one is able to possibly exhibit on some of the portfolio segments, again from a risk underwriting perspective. And thirdly, as what I indicated, we are kind of carrying out a lot of investments, particularly on building some of the franchises. Now, some of those investments are already, as I said, seeing early signs of success in terms of incremental growth. So that should also kind of bring in efficiency in operations. And finally, we are kind of as a company doing a lot of thrust and focus in terms of building efficiencies in claim service. So there are multiple levers that are available with us. And at this point of time, we believe we should be on our course to possibly get to a trajectory of 102 over the next 2 years. Having said that, obviously, we will wait for how the market kind of responds, because if you look at the industry combined ratios are currently operating in the range of, I would say, between 116 to 118%. So in that backdrop is where we are saying that we would want to see a glide path from 104 to 102 over the next 2 years. So that's in response to the first one. On the second part of your question in terms of the return on equity, there again, I think to the market, what we had spoken about was a sustainable ROE, which will be in the high teens, which will be in the range of about 16 to 18%. And if you would have seen maybe the exit return on equity that we had seen for the current year, we were at about 17.7%. So hence, we are pretty confident in terms of the ROE trajectory as well, kind of staying in that high teens range within that 16 to 18% bucket.
Right. The other thing I wanted to understand was, that Bhargav Dasgupta has been leading the organization, since 2009, but his term ends in 2024 May. He's been prolific in leading ICICI Lombard. Could there be a risk of a void in leadership here?
So I think ICICI Lombard are institutions, and therefore to that extent, there are enough, I would say, leadership bandwidth that exists both internally as well as within the group, and the board is seized of this particular matter. And succession planning is something that we actively kind of involve, not only with respect to CEO transition, but even across layers of management. One definitely looks at succession planning very, very actively. Having said that, the time period that you kind of indicated is presently in the draft form that the regulator had put out to say that the CEO term will be possibly be for a 15-year period, which is what Bhargav term possibly comes to an end in May 2024. I think we will have to wait for further regulatory guidelines in terms of how that particular thing evolves. But having said that, as I said, the board actively involves and engages in succession planning conversations. And in terms of leadership depth, both within the institution and within the group, I think there are enough capabilities that are available. And maybe at an appropriate time, as an institution, we will come back to the market and make necessary announcements as required.
In Q4, your OPEX had moderated slightly. Just help us break it down for us, and what is the level of capex that you've been affronting?
No, so I think clearly when you look at operating expenditure when you look at, rather than just looking at just operating expenses, you have to look at both the overall expense of management. In general, in periods when you see a relatively lower growth, obviously corresponding to that, you also see a relative lower cost of acquisition. And for Q4, as you have seen for us, the growth was slightly moderated, and hence to that extent is also a factor in terms of the operating expenses being relatively lower. Having said that, I think if you look at more the overall thought process in terms of how do we want to drive going ahead, the combined ratios to the streets, we had kind of talked about at the beginning of the year to be around 104% by the end of the year. We are pretty much around that. And over the next 2 years, we would want to see this combined ratio go down to a trajectory of about 102%. And a key influencer in terms of achieving that particular combined ratio objective will definitely be expense of management as one of the levers. And at the same time, we will also continue to focus on claims efficiency as well. Both of them will kind of aid in the thought process of bringing down the combined from the current 104% level thereabout to 102 over the next 2 years.
And your loss ratio has seen a sequential jump, and you've also got Motor OD, which has seen a jump on a full-year basis. Do you think that this pressure will continue?
So as we keep saying, I think our business has got a lot of cyclicality attached to it. And hence, to that extent, one should not really necessarily compare loss ratios, particularly on a quarter-on-quarter basis, because there are a lot of factors that gets influenced when you look at a particular loss number for a given quarter. The same number possibly when you would have looked at, let's say for quarter 3, you would have possibly seen an improvement in the loss ratios for some of the segments that you referred to. A better way will be to look at more on an annual basis, and that's far more sustainable if you were to look at in terms of the way forward. Having said that, I think we keep evaluating in terms of the product mix that we want to kind of drive in terms of the underwriting objective. At the same time, some of the segments, wherever it warrants a change in pricing, we would not shy from taking a price increase. For example, on the retail health, in the month of February, we effected a price increase of almost about 19% on the renewal book of that particular segment. Similarly, motor, the segment that we spoke about, is also a segment where we have effected a single-digit price increase as we speak, particularly in quarter 4 onwards. So hence, to that extent, a better way in terms of the loss number is more a full year number as compared to looking at more on a quarter-on-quarter.
Right. Great to have you today on the show. Thank you so much for taking the time out, Gopal, and speaking with us today. That's the view coming in from the ICICI Lombard management.